Hello everyone, in this video we would be starting with the chapter number 11 and of CMT level 2, and it is short term patterns. This is going to be comparatively shorter video because this is a very simple chapter and most of the concepts were covered in the level 1. Okay, so first we'll begin with the learning objective statements. Now what we're going to do in this is we are going to analyze reversals in long term trends using the short term price patterns. So what we are going to be particularly studying in this chapter are the short term patterns only, and we are going to see the reversal patterns. Reversal means the change in the trend, change in the previous trend, and we'll see 1 and 2 day bar reversals. We'll see some candlestick patterns, and we'll see what are the narrow range bars. All right. Okay. So in this chapter, our focus is on short-term patterns, on bar charts and candlestick charts. These patterns concentrate on the configuration and characteristics of the individual bars, such as the height of the bar and position of the opening and closing. So most of us use the candlestick charts, and I know that we don't really use the bar chart, but there are people who use the bar charts, and sometimes even the bar charts are useful. I feel like we are exposed and introduced to candlestick charts, so we never really go and look at the bar charts, but sometimes what happens is bar chart suits us better than the candlestick chart, so you should check that as well. So short term means basically we are seeing a shorter duration, or we are going to see lesser number of candles instead of on a monthly chart or a yearly chart and stuff like that. Okay. Although the longer term patterns we have considered can be useful by themselves, they occur less frequently as compared to the short term patterns. Obviously, something which they occur less frequently. Why? Because it takes a lot of time for the long term patterns to be formed with respect to the duration of forming, whereas the shorter time frame ones are formed more frequently, obviously. So if you take a live example of that on TradingView, let's go on a random chart. Okay, this is a 30-minute chart. Now if I look at it, can you spot a W pattern anywhere? Let me know if there's a W pattern anywhere. Okay, let's take a double top. So here I can see a double top. Okay, let's find more double tops. Here also I can see a double top. All right, and where else can I see a double top? That's it. Okay, now let me go on a 1-minute chart. Let's find double top over here. This is a double top, 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 this is a double top. So did you see the frequency of the pattern occurring on a shorter time frame is more as compared to that of the longer time frame? So that's what they have explained. Moving on. All right, so whenever we talk about a candlestick chart or a bar chart, there are 4 pieces of information: the open, close, high and the low. High and the low is depicted by the candle's wicks. So if I change the type to bar chart, then you can see clearly that this is how a bar chart looks. Now how do you read a bar chart? Very simple. This is the open, this is the high, this is the low, and this is the close. The same way with the red as well, just the opposite. So that's how you are going to read. It is very similar to the candlestick. Ashwager states that when referring to 1-day reversal pattern, it successfully calls 100 out of every 10 highs. Like Schwager, many have been skeptical about the validity of the short-term patterns. So people obviously trust the long-term patterns more as compared to the short-term patterns, because the short-term patterns have a larger failure rate, right? That's obviously because of the noise and because of the erratic movements. In most successful tests, short-term pattern entry signals are closed either at the close on the same day, the opening of the next day, the first profitable opening, called the bailout by Larry Williams. So bailout, what is bailout? Bailout is basically the first a profitable opening. Okay. Nevertheless, once fully understood, short term patterns are useful not only for trading but also for entering and exiting longer term positions at a more favorable prices. So, you know what is inter time frame analysis. People look at the 3-hour chart, 1-hour chart, and then take their entry on a 15-minute chart. So, you can always use a shorter time frame to take a better entry, and that would increase your profitability of winning. So, that's what they're saying. Okay. The average investor would not usually have the time or computer equipment and data feed to watch for shorter time frames. The professional trader has the ability and can improve. So that's why it is always advised to also look at the shorter time frames when you are taking a trade. The basis for the short term patterns is to anticipate a sudden move, similar to the breakout concept in the larger patterns, to take advantage of a period when prices have reached an emotion extreme. Now, let's say I also exit when I look at a situation in my shorter time frame. So that will also help me reduce a significant amount of risk, obviously, right? The methods usually have what is called a setup. We all know that we need to have a particular setup before we take any trade. A setup occurs when certain known factors needed to establish the patterns have occurred and the trader is waiting to enter. So, what is a setup? A setup, let's say I am a person who is trading only crossovers and moving averages. So, for me, the crossover has to occur, and that is my setup. That is my particular setup. For somebody who is waiting for the breakout of the resistance, that is their setup. Alright, they have just explained it more. Short term patterns are relatively frequent and usually depend on the previous trend as well as other factors. The prior trend must be known. Okay, obviously, you need to know the prior trend, you need to know the trend which is going on in the larger time frame before you enter something. Sometimes, what happens is, let's say, let me go to a random stock. Okay, yeah. So if you look at the 1 minute chart, what is happening in the market right now? It's 1:14 p.m. So the market is open. So I can see that the market is in a downtrend, right? Like if you look at it, the market is in a downtrend. Now, if I go on my daily chart, I can clearly see that my market is in a uptrend, right? It's going up only. So do you think it is wise for me to take a decision of shorting it right now just because the 1 minute candle is saying so? No. So you need to always confirm it with the prior trend, and you need to always check with the other time frames as well, and you need to see if the trend which in the direction of which you want to take the trade are all the time frames also supporting your view. That okay. Whenever many bits of evidence occur at a particular price on time, it is called a cluster of evidence. So you need to have a cluster of evidence before you take a trade. You can't just be like, as soon as a crossover happens, I will enter into a trade. You need to have 2, 3, 4 more confirmations of other indicators or whatever your strategy is before you enter a trade. For example, if you talk about a cluster of evidence of, let's say, the M pattern, you want the M pattern to be formed, you want the breakout candle to occur, you want the breakout candle to be very strong, you want the volume of the breakout candle to be very high. So these are the criterias which are very important, and these are the things which are basically the cluster of evidence. Short term patterns can also be used to determine when upward or downward momentum is slowing. That is again confirming with the charts. Although short term patterns are usually reversal patterns, they can be used as continuation patterns in corrections within a trend. Okay. Shorter term patterns are best when they occur right at the peak evidence that a longer term reversal is due or that a stronger trend is due to continue. For example, in an uptrend, if the price is near the previous resistance, okay. So what they're trying to explain is that whenever you are taking a trade, let's say, okay, today let's say I want to buy, I have a plan to buy TCS. So, but if I go on a shorter term time frame, I can see that today the stock didn't do well. Today from morning, the stock was going down. So, do you think I will enter into this? No, because the intraday action wasn't good. So, I will not enter on the daily chart. So, you need to always confirm it with the shorter time frame. Shorter term patterns are also the first sign that the reversal is nearing. In order to exit early and to mitigate the risk, You should always be using the shorter chart patterns and shorter terms charts. The more complex the pattern, the less frequently it is going to occur. Some analysts, okay, read this. This is about the computer screening program. And relationship between bars in a pattern need not be a matter of position of the high, low, open, close to each other. This relationship can be proportional to 1. Okay, what do they mean? See, basically, if you see the example which they've given over here, the close is in the lower 33% of the trading range, or the range that is 3 bars earlier, one half of the range of the last bar. So now this is a particular pattern which they are taking into consideration, and this is their evidence using which they will trade. So you can have different variables like that attached to your trading system, to your trading setup. After considerable backtesting, you can see what works the best for you. Okay. Now let's talk about pattern construction and determination. So we know that what is the opening and the closing price, high price, low price of the day. So if it's a daily candle, then it's of that particular day. If it's a 5-minute candle, it's of that particular 5 minutes. If it's a 1-second candle, so we all know that very clearly. I'm assuming that you know about it since you've done your level 1. Now, what is the final price of the day? Final price is always going to be the closing price. So what was the closing price of the stock? That will give you my final price of the day. Okay, and it is basically the closing price is going to give you the summary of whatever happened during the day. And if the close is up, which means our candle will be in green, that means that it was a good day. Whereas if it's red, then that would be downside. Clear? And what do? We basically look at the, like right now we just saw the example of TCS. We were seeing that today's candle is red, so in that case we will not buy for tomorrow. So that's how we can judge. Most of the people judge using the candles. Okay, and we know what high is and we know what low is. High is the highest the buyers could take today, low is the lowest the sellers could take today. And the configuration or the length of the bar, length is basically going to show you the range of the bar. So how many, if you're talking about forex, how many pips it traveled in a day, or how many rupees it adjusted today. So what was the range of the bar? Now that. Now, when we come to traditional short-term patterns, now let us look at them. These are the short-term patterns. The first thing are gaps. Let's just look at the real-time chart and see what a gap is. Let me go on a 3-hour chart. Do you see this? Do you see this gap area over here? There's nothing over there. That's a gap. Do you see this particular area? There's nothing over there. That's a gap. Do you see this area? That's a gap. So this is what a gap is. So I hope that is clear. So why does gap happen? It's either because of the selling pressure or the buying pressure which was there overnight after the market closes. Okay. So gaps occur either the low for the current bar is above the high for the previous bar, or high is low from the low of the previous bar. That is the meaning of gap, obviously. That's the reason why a gap has been formed, right? And the hole or void created in price history because no shares changed hand. So we've all heard phrases like the market opened gap up today, the market opened gap down today. So in the middle place where the gap was there, no trading activity has taken place during that time. Okay. We have also seen what are support, resistance, and all of that, right? So you need to keep in mind that sometimes gaps also behave like support and resistances. Gaps often do not occur in market averages that are not themselves traded. Okay, so what do they mean? There are some instruments which are not traded, right? In those, you can see that gaps do not occur over there. Why? Because since it is illiquid and since trading does not take place in that, because of which there is no gap in the chart itself. For example, if you see the interest rate charts on TradingView or any other website, if you look at the interest rates, the chart is going to be clear and there will be no gap in the chart. Now, why did that happen? That is because we can't trade in the interest rate, right? Due to which there is no gap. Okay, next. No gap existed in DJIA because it's an average, not a security. Okay, that's what they've said, what I just explained. Okay, so they are basically showing you how a gap looks in a bar chart, and we know what a gap up and a gap down is. If the same thing happened somewhere over here, it would have been a gap up. Here it is the gap down, and this is a bar chart, so make sure to keep that in mind. Okay, now let's see the type of gaps which are there. So the first thing is a breakout gap or a breakaway gap. Now try to understand what the word says. The most profitable gaps are those that occur in the beginning of the trend, which is known as a breakaway gap. Now, breakaway gap is that kind of a gap which is the beginning of a particular trend. For example, let me look at this. Okay, so if you look at this over here, TCS has been rallying and it has been going up, right? It has been going up. Here there was a gap. Suddenly from there on it started going down. So this is my breakaway gap. Why? Because a new trend started ever since that gap occurred. Now let us read what they are explaining. Breakaway gaps signal that a pattern is completed and a boundary is penetrated. So a boundary is penetrated. The size of the gap, the space between, appears to be proportional to the strength. Obviously, we can see how strong the movement is. Now, if I let's see the same example actually. If you look at this, here the gap was significantly big. Like the gap was so big because of which the trend sustained, right? Whereas now let's find a very small gap. Okay, so if you look at this here, the gap is not that big, which is why the trend couldn't sustain. So that's what they're talking about, the proportionality. Heavy volume usually accompanies upward gaps but not necessarily downward gaps. That usually happens and it is a researched fact. The best manner of trading breakaway gaps is to wait for a while, and you need to wait for profit taking. So you must have observed, especially in the Nifty 50 index, on the days whenever the index opens a gap up, usually the gap gets filled, right? So why does that happen? The gap gets filled because a lot of profit booking takes place. If the gap is filled immediately, a stop and reverse might be appropriate because a sudden failure in gap is often followed by a large move in the direction from the gap direction. So you need to keep that in mind. Alright. And now there is a thing which is known as explosion gap pivot. First of all, I hope you know what a pivot is. You must have used the indicator pivot point, right? In this particular, here what they are talking about, a pivot, that is not pivot point. Okay, pivot point is something which gives you anticipated support and resistance levels. Here they are not referring to pivot points, they are referring to pivots. What is a pivot here? Pivot is basically a reversal point. Okay, and a pivot point is basically where the prices have like basically reverse. For example, if my price has been going up and from here it went down, so this is my pivot. That is what they are referring to. All right, anyway, okay, we know that the breakaway gap can be a false gap and it is filled, so that's what I just increased to you. And thus we want a breakaway gap to establish a new high for at least the past 20 days and for the subsequent retracement to not fill the gap. Sometimes the gaps are filled, right? When they are filled, they are not known as breakaway gaps. Breakaway gaps are only when they are not filled in nature, okay? And sometimes you obviously know that every healthy trend must have a retracement. So if the stock is going up, it might retrace and it might go up again, but the retracement should never be into the gaps ever. Now let's come to the opening gap. What exactly is an opening gap? So opening gap is when the opening price of the day is outside the range from the previous day. That is known as opening gap. So that is as simple as, very simple. Opening gap is just that from yesterday's range, today's opening is much above or below the yesterday's range, which means that the price opened. We are only talking about the opening price. So that will basically mean that it is an opening gap. Now, if the prices continue in the direction of the gap after opening, then obviously that is known as a breakaway gap, right? We know that. But sometimes what happen is they can just fill the gap as well. Now if we look at this explosion gap, this is one of the example of the explosion gap. If you look at this, here there were candles and here there was a very big breakaway gap of nearly high for 20 days, which means from the past 20 days this has been the highest. Okay, the previous past 20 days this has been the highest, and then you can see that the candle came retraced, but it didn't fill the entire gap, it didn't fill all this. So the candle came in retraced. So if this was a green candle, this one over here, then I would enter above the high, stop loss would be below this, and that's how they would enter. And this is known as an explosion gap. Hope you understood it. Not that difficult. If you're listening to what I'm saying, it won't be that difficult. Okay, so the history of opening gaps in index futures suggests that they should be faded on large openings because most of them fill. So I told you that most of the times, even if when Indian index opens a gap up or a gap down, then it usually retraces and it in fact fills the entire gap which was there. So in a downward opening gap, a fill is not as common. So if you look at gap up and gap down, gap up is usually filled. Gap down is usually not filled. So it is filled sometimes, but it is not that frequent. If the gap is not filled, usually within the first half hour, the odds of the trend continued in the direction increases. So whenever you want to trade, let's say a gap up, then wait for the first 1 hour and see how the market is performing. If in the first 1 hour also the gap hasn't been filled, then in that case you can be sure, not you can't be sure about anything, but you can be more confident that the price will now not retrace and not fill, because in the first 1 hour if it did not happen, which that means that people are willing to take the prices higher and so on. So keep that in mind. Just a second. Alright. One potential way to profit from an opening gap is to watch the first 3 5-minute bars, a 3-bar range. So this is what they are talking about, an intraday strategy. So they said that first there's an opening gap. Okay. After that you are waiting for 3 5-minute candles. That is the first 3 5-minute charts. Sorry, the first 3 5-minute candles. And then you will see the high and low of this range. A breakout of that range in the direction of the gap often indicates that the trend will continue in the gap direction. A breakout that moves in the direction of filling the gap will often continue to fill the gap. The danger is that first run from the gap that can last longer than 3 bars. A 3-bar range must therefore be obvious, not a continued run in the gap direction. The 3-bar range must therefore be obvious, not a continued run in the gap direction. In addition, the breakout from the 3-bar gap range in the direction of the gap may be false. A tight stop is necessary or wait for a pullback before you enter. So looking at an image of what they're saying, look at this. I will show you the example on TradingView what they're saying. So where is a let me just, these are candles only. Okay, so they were saying that first of all set your time frame to 5-minute charts, and after a gap wait for the first 3 candles, and when the first 3, and then mark the range. Okay, so let me just take what is in front of you to show you that it doesn't always work. So here there's a gap up, right? So first candle, second candle, third candle is red, so I'm not very happy with it. So I will mark the high of the first 3 candles, low of the first 3 candles. Do you think I should enter over here? Do you really think I should enter over here? Think about it for a second. This is Tuesday 9:15. This is Tuesday 2 o'clock. Okay, now I'll just tell you what happened. The high never broke. The high of the day of the first 3 candles did not break. Let me check it. 3539.05, 3539. Yeah, it did not break. But the low broke. The low broke somewhere over here. Yeah, it broke over. The low was 3523. 3523. No, it broke. Okay, it broke over here. Would I enter over here? If I would have entered, just a second. If I would have entered, then I would have booked a little bit of profit on the put side. But would I advise that? No. What would I advise? I would advise that go only when the direction is towards the gap level. Okay. So for example, if you look at this, now there has been a gap down on this day. On Wednesday, there was a gap down. So first three candles, I will mark the high and the low. Low has been marked, high has been marked. So here, if I would have entered when the high was broken, then I would have captured this whole move. Okay, this whole upside move. But what did I say? I would prefer if you only go in the direction of the gap. So I personally wouldn't have traded, but they are basically saying that you can trade like this. Let's see more examples of the same. Here I don't see any gap. I don't see any gap. Here I can see a gap. Okay, so on Tuesday 16 November 9:15, first three candles, this is the high, this is the low. Okay, now you can see somewhere over here, which was 10:15, my high has been broken. So I would enter above the high and look at this. I would have captured this whole thing. So looks good. Now let's go and see more on TCS. Again over here. Okay, so if you look at this, on 9:15 Wednesday, I have a gap up, so I mark the high, I mark the low, and if you look at it, here somewhere over here my 9:55 this breached, so I would enter above the high. Stop loss I wouldn't keep a stop loss. The stop loss should be a day low in this case, and imagine I would have made money. Did you see that we did not even see one failure until now? We didn't even see one failure. Again, let's do it over here. So here there is a gap down. I mark the high, I mark the low. Okay, so here it broke and then again it went down the whole day. So that's how you can trade a 3-bar range when it comes to, just a second. Yeah, when it comes to trading using the 3-bar 5-minute candles. And this one over here, this was the Muhurat trading on the Diwali day. That's why you can see that on Sunday the market was open. Even I was a little bit confused, but yeah, this was the Muhurat trading day. Okay, so now you can backtest this if you want to, how to trade the gaps. So the rules are very simple. I will write it for you. What they have given is that see a gap up or a gap down, and then see the breakout on either direction. First 3 5-minute candles, enter and let it run for the day, and stop loss can be the day low or the day high. Love that, honestly, and it worked really well on TCS if you look at it. That's what we've been backtesting from that time. So I really liked how it worked on TCS. Let me look for today. Today there hasn't been a gap, it opened flat. Okay, next. This is what we've been seeing. You can read this, we've discussed this whole thing. Okay, now we saw what are breakaway gaps, right? So they were, we know what breakaway gaps are. Now let's see what are runaway gaps. Runaway gaps, okay, again, breakaway gaps are those gaps which are the beginning of a trend, okay? And runaway gaps are those gaps which occur along a trend called as the runaway gaps. So they can appear in strong trends that have few corrections, and they are also called as the measuring gaps because they often occur in the middle of them, and an upward gap occurs on 43% of the distance of the trend, and a downward happens at 57%. Keep that in mind. So let me just write it for you. Breakaway gaps are starting of a trend, And runaway gaps, they occur in the middle of the trend, and they are usually continuation gaps, and you can see that they basically occur. Now those percentages can be tested in the MCQs. As much as I hate to say that you need to learn the percentages, you will have to. It happens in 43% of the distance from the uptrend, from when the uptrend has begun. Let's say this is my uptrend. If this is the 43%, let's say from the beginning of the trend this is 43%, then here the gap will occur. Alright. Okay, 43% is for the uptrend, 57% distance is in a downtrend. So that is my runway gaps. Runway gaps are also known as the measuring gaps, and opening gap is called opening gap only, and runway gaps are also known as the measuring gaps. Alright, now let's come to what is known as an exhaustion gap. You can understand by the word itself, it means exhausted, which clearly means that this is something bad, right? So exhaustion gaps usually occur when the trend is becoming weak, or when some particular move is coming to an end. Okay, so they occur at the end of the moves, but they are not recognized at that time because they have the same characteristic as the runway gap. So just like the runway gap, they also occur in the middle of the trend. So we can't really understand if it is an exhaustion gap until and unless the day closes. Okay, so if the gap is later closed, it is likely that an exhaustion gap. These gaps appear when a strong trend has reached a point which greed or fear has reached its apex. So you need to keep in mind that greed and fear are done now. Okay, and they basically are sent so that the late people immediately exit from the position. They like to square off the retailers, to be very honest. The sign that the gaps are not runway gaps is an immediate fill within few bars of the gap. So the moment the gap has opened, they get filled very quickly. Now that is a sign that it is an exhaustion gap. So keep that in mind. So how do you basically justify an exhaustion gap? It is basically when a gap occurs, a gap up happened. So you might think it is a continuation gap, or you might think that it is a runaway gap only, but it gets filled very quickly within the first few bars of the day. Then that clearly shows you that it is not a runaway gap. In fact, it is an exhaustion gap, and the trend has come to an end. And the people who entered into the trend at a very later stage, they basically suffer, and their stop losses get hit, and they get out of the market due to that. Okay, so now we have the other kind of minor gaps and stuff like that. So these are basically very these are the kind of gaps which occur due to reasons like the company has introduced some dividends and the stuff like that. There is some kind of news about the stock in the market, and things like that, which cause small minor gaps. So that is the other minor gaps. So often gaps occur in 24-hour trading futures. Often gaps occur in 24 hours futures trading when one market closes and another opens, especially if the market is electronic. These are known as suspension gaps, and they are also meaningless unless they occur on the four principal gaps described previously. So what do they mean? So for example, what happens is, I hope you know a company, Nestle, right? So if I go on Nestle, what happens? Look at this. I just went on Nestle. It's there. This is the Nestle Pakistan. It is listed on Pakistan. Now, when you go on Nestle Nigeria, it is listed on the Nigerian market as well. If you, even though the charts are not looking good, honestly, if you go on, let's say, India, then it is also listed on India. So let's say when my Indian market is closed but the US market is open, then the trading in Nestle has taken place in the US market, right? Even when the Indian market was closed. So due to which the next day the Indian market Nestle opens a gap up or a gap down, because it has missed the kind of rally which has happened in the US market when the market was closed in India. So those kind of gaps are not that important, and they are known as the suspension gaps, which are usually because timings and listed in other markets. that. Next we have a box. I don't think it is visible. Okay, so beginning with this box, I know nothing is visible, so you just focus on the picture over here and I will read it for you. So this is basically a case study of how to trade gaps when they are given, and how to basically combine volume with the gaps and other patterns which we have been studying. Just a second. Okay, so the first thing we can see that the chart which is given over here is of Apple. Alright, so this is the case study of Apple computer. And first we can see a small pennant formation with an upward breakout. So that is the first pattern which we can see. This is a pennant and then there has been a breakout, right? And after that we don't have the past history, so we don't know what happened before, right? So for the then you can see the upward gap. You see a gap over here, right? And you see a gap over here. So these are the gaps which are also given in the middle of the trend. So how would you trade that particular gap? So we use them to place trailing stops. As the price progresses upwards, the pivot low after the gap 1 is the first trailing stop at 169.7. So because if the price comes back into the gap, we know that it might be failed, right? So that. And then you see what there is a flag over here, so you will trade it when it breaks out, and your SL would be the gap. Now what happened in this particular case? You can see that the breakout is accompanied by the gap 3. Over here you can see the gap 3, and later on you know that your stop loss has been hit. Why? Because the gap has been filled over here. So that would have been an invalid trade. And we place the protected stop at the low of the flag, that is 180.7. So where is 180.7? 180.7 would be somewhere over here. Okay, so whenever you're trading the breakout of a flag, you know that you would place your stop loss at the low of the flag, right? So okay, because of which they are saying that your stop loss hasn't been met yet, right? Why is the stop loss not met? Because when you're reading a flag pattern, your stop loss would be below the flag. Okay, then there is a gap 4, and if you look at the gap 4, it is over here. So what is this? This is a runaway gap, which means it is a continuation gap, right? And it is neither case should prices fill the gap. So even if it's a breakout gap or even if it's a runaway gap, the gap should not be filled. So after that, what happens is, wherever our stop loss was, now we are going to move it above to the gap 4's upper limit. So I will make my stop loss over here, which would be trailed in a few candles. And obviously our stop loss has been triggered over here, where we have to exit from the trade. Very simple. And then we get a profit because we have trailed from here to here, so that is a profit. Okay, now let us see what's next. The price then forms a downward flag pattern, right? After our exit has been triggered, there's a downward flag. So what are you going to wait? You're going to wait for the flag to break out, and usually we saw that when flags are made downward, then the breakout happens on the upside. We know that also. So what will we do here? And we will also check it with the volume. See, during the formation of the flag, the volume also declined, showing me that it is a good sign for me, because during the formation of the pattern, I usually want my volume to decline. So then the break upward, the flag triggers at 190.7, which would be somewhere over here, 190.7. So I will enter there, and my stop loss would be below the flag level again. Okay. And then you see a gap 5. Where is the gap 5? So my gap 5 is somewhere over here. I don't know if you guys are able to see it clearly, but just a second. Yeah, so here, gap 5. Now that is again a runaway gap or a breakaway gap, right? So in that case, what will you do is, again you will trail your stop loss, and You can also see that the break from the flag gives you an entry, right? And then you can see the move projection from the gap is 200.73. Why am I saying that? Because look at this. Yeah. Now, why am I projecting the move to be till there? Because you can see that previously the price went there and reversed right from there. So you would book over here because the chances are that it will reverse from there. Alright. Now, if we wouldn't have sold at the target price, then we would have placed a trailing stop loss at the gap 5 upper level. So that would be here. We would have placed a stop loss over here if we wouldn't have sold at the target level, which would eventually have been met somewhere over here. Okay. Now we are done with pennant, flag, downward flag, and we're also done with this gap. Now let's come to how to trade the symmetrical triangle. Okay. Let me check. The breakout is not only through the gap but also through the lower bound of the broadening pattern indeed. Okay, so they're talking about the broadening pattern over here. So you know what are broadening patterns? Initially the price was converging and then it started broadening. So here it broke out, you would enter over here and you would place an SL over here. And if you look at it, there was target has not been met, but here it was a symmetrical and it gave an upward breakout. You would enter and you would keep a stop loss over here. The price went up and then opened with a gap up, so you will place your new SL over here. Then the price will go converge again and break out and go up again. You will place your SL over here. Then when it's going up, you will place near the gap and so on. So I hope you understood how to trade these patterns in real charts, since that is extremely important. Okay. Now we come to see what are spikes or what are wide range or large range candles. So spikes are when there are immediate price spikes in the particular stock or instrument. So spikes are similar to the gaps like we saw, but the only difference between spikes and gaps are that in the gap there is no candle in that area, but when it comes to spike there is a big body candle in that area. So instead of a gap in that area, there is a candle in that area. All right. So you can see that spikes are similar to the gaps, but the empty spaces associated is a solid line in a bar chart. So you are basically talking about big body candles in this. Should a breakaway gap occur intraday, the daily bar should not show discontinuity from the gap, but instead should show a long bar chart. So which means that they are saying that it should be full green. That's what I just explained, right? All right. Now, you need to know about one thing. We also discussed what a specialist breakout is. We've just discussed that. And this is often a spike because it usually occurs in intraday. At the end of the trends, when either gross enthusiasm or panic appears, the last few bars are often spike bars. So what happens is that whenever the trend is going to change, usually what happens is during the end of the trend, spike bars appear. Like if you look at, let's say, daily chart on bail. Okay. So look at this. The price was just a second. Okay. So for example, let's take an example. Let's look for some good example. Okay. So if you look at this, the uptrend was going on and here it made a big green candle. What happened after that? Big green candle with no lower wick. The price came crashing down. So whenever the trend is coming to an end, usually the last bars are spikes. You can see for more examples on TradingView. At the end of an accelerated trend, the last bar within the trend is often called of a spike is often known as a climax. A climax is usually the last bar of in an accelerated trend or an over exhausted trend. So spikes can represent the beginning or end of the trend. On the other hand, some stocks and commodities, especially those which are awaiting news confirmation, so stocks like that who are awaiting news confirmation are usually more volatile in nature, so even they have. So I hope you understood what is a spike. Now we come to DCB, a very interesting concept. It is known as the dead cat bounce. Now, what exactly is a dead cat bounce? Sometimes what happens is when there is a decline or when there's a downtrend, suddenly the price starts going up, but it couldn't sustain and it falls back again. So this failed rally is known as a dead cat bounce. Okay, so failed rally after a sharp decline, that's how they have defined it. And the DCB is the most profitable or more easily recognized after a large downward breakaway gap or downward breakaway spike. The sudden downward motion is called an even decline because it usually comes on an event such as a bad news announcement, and it obviously the market players are reacting to the news which has come in the market. Okay, so that now looking at this chart over here, this is of US steel, so you can see that a rally has been going up, and in the end you know that big green candles are going to be there, and the end spike is always known as a climax. So after that you can see how the commodity decline basically. Okay, all right. So when we look about the characteristics of the dead cat bounce, you need to understand that it will include a short rally of seventh sell off. Wait just a second. Yeah, so it is going to have a short rally of very like major severe sell off, and you are going to identify that bit with that. And ideally you need to keep in mind that the rally should happen after the even decline of more than 20%. Okay, the bounce comes from the bargain hunters and take place. It gathers momentum from short covering, and momentum buyers are usually wrong. In more than 67% of the dead cat bounce, the price continues to lower than the DCB and breaks the earlier news by 18%. Keep that in mind. And also, the second decline in DCB is less intense but deceiving. It also tends to be accompanied by much lower volumes. Now, how do you practically trade a DCB or a dead cat bounce? So, first of all, the event decline must be recognized. You need to recognize that, okay? And it is almost every day somewhere some or the other bad news comes in some or the other market. So you are going to wait for a proper event fall off, and then you will have to recognize that a rally has been going on, and usually it's with a lower volume, and then it's going to fail, and you can look for signs somewhere over here to enter into the DCB. So somewhere some bad news comes out to some or the other company every single day. So wait for the initial sell off volume to decline, then look for a rally on a lesser volume. Sometimes the back as far as lower edge of the breakaway gap. Okay. So what you have to wait for, first you have to identify that there has been some bad news in the market in the particular stock, and you are going to wait for a major sell off to go on, and you're going to wait for the volume to be very high during the starting, but towards the end the volume goes down, and then you're going to wait for a rally, and then you will soon enter when you see a favorable thing. Looking at this, the price first went up, then it break down, and there was a gap down, there was a sell off, gap down happened, there was a major sell off, then rally was happening, but it was a failed rally, and the decline continued ever since the gap happened. So this is the example of a dead cat bounce. Alright, now we come to another concept which is known as the island reversal. A very basic concept you need to know before studying this topic is that what is an island? Island is something which is away from the mainland, it is away and it is a bit distant. So keep that in mind that if rest of the country and the rest of the world is here, then island is situated somewhere between the sea. This is the sea and island is situated somewhere over here. So you can see it is very far away from the usual land or from the home. So that is the small concept of island you need to know. So island reversal is something which is obviously depicting the reversal, which means there is a trend change. So that usually occurs when there is it occurs usually either at the top or of the bottom of the trend, and a relatively lengthy trend. It can happen in congestion area but only infrequently. Okay, so first you need to see that what is a breakaway gap and what is a runaway gap. I hope you are clear with that very well. And just a second. Yeah, so I hope you are clear with that. Now, the larger the gap, the more important is the formation. So initially the trend was like this, and suddenly there has been a gap in here, there is some movement. So this is my island because it is much far from the previous, and then even there was another gap again. So you can see that this particular piece of price action is away from the usual price action. So which is why it is known as an island. Okay, between the gaps, low volatility trading can occur for a number of days. So this piece is, I don't know if you can understand my drawing, but this piece in the middle, the volatility is very low and the volume is very low in the trading over there when the price was in that particular range, and that is what they are basically saying, that how island are formed. When does the volume increase? So volume basically increases on the second gap from the island top, not necessarily from the bottom. So keep that in mind whenever you are trading an island. The extreme price in the island must be either higher than the previous high at the top or lower than the previous lows at the bottom. Pullbacks and throwbacks are frequent and failures are low. This pattern is not common and has terrible performance result. So I would not advise you guys to trade that, but I hope you understood what island really is. Island is basically price action has been going up. Now there is a gap, and then here little bit went on, and here again there's a gap up. So this particular low volatile price action took place in the middle, and it was not volatile, and it was separate from the upper movement and the lower movement. So that means that it was not good. Okay, now we have come to the 1 or 2 bar reversal patterns. Until now we've been seeing a cluster of reversal patterns, and now we come to a 1 bar or a 2 bar reversal patterns. So what do you understand by 1 bar reversal? So 1 bar reversal is when you're able to see a reversal by just looking at 1 bar. So it's also called as a reversal bar or a climax bar or the top or bottom reversal, key reversal bar. So we are basically referring to one particular bar which gave you signs of reversal. So when a trading bar high is greater than the previous bar high and the close is down from the previous bar close, it is called as the 1 bar reversal. So if the high is higher than the high and if the low is lower than the previous low, then it is known as a 1 bar reversal. And sometimes what happens, that it happens along with a gap. At least if not an entire gap, then at least an opening gap. And its bar length is not as extreme or intensive as in a spike. It is not a spike because a spike is not necessarily a reversal, but a combination of spike and reversal can elevate its meaning. This pattern will occur in reverse at a bottom. It is common, but unfortunately its top and bottom version will also occur within a trend, making it practically useless as a signal itself. So you need to not just look at the pattern somewhere in the middle of the trend and just take a trend and just assume that it is reversal. You need to always consider it with other characteristics, because otherwise you might have a lot of whipsaws. Again, let's take an example of the same. Rather than just closing down, the close may be required to exceed the previous bar low or even the low of 2 previous bars. So you can make criteria like this, that it should exceed the low of not only the previous bar but also of the bar which was before that bar as well. And this is how you are going to do it. When combined with a cluster of other evidence, you can take a trade. So that is my 1 bar reversal. Now we come to the 2 bar reversal, and it is also known as a pipe formation. Keep that in mind. Whenever we are talking about a 2 bar reversal, it's known as a pipe formation. And the 2 bar reversal is basically just like the 1 bar reversal, which means that it also occurs at the end of the trend. So that's the similarity between the 1 bar reversal and the 2 bar reversal. Both of them occur at the end of the trend, okay, upward or downward, but extends the reversal over 2 bars. So the reversal is not just in the 1 bar, but it is also extended towards 2 bars. So that is what is explained, and that is what is the difference between the pipe formation and the reversal bar, or the climax bar, or the key bar. All of those names are of 1 bar reversal. Keep that in mind. Okay. So if I have to show you the picture of 2 bar reversal, this is how it will look. So what did you understand by this? A downtrend has taken place, right? And the downtrend has taken place. Then what happened? In the bottom pattern, you can see, right, that it's forming at the bottom of a trend, which means it is the end of a trend. That is what you can see. A 2 bar reversal, this is what is referred to a 2 bar reversal. Okay. Now you can see the first bar usually closes in the lower half of the bar, right? So the first bar opens over here, went up, came down, closed over here. So it basically covered only half of the bar if you're talking about the opening and closing range, right? And you can see the second bar closes near its high. So if you look at the second bar, it opened over here, went up, came, closed. Do you agree? Okay. So if you're getting confused, let me show you a real chart for you to understand better. Oops. Alright, now if you look at this particular candle over here, this one, let me show you how to read the open and low price, because I understand that sometimes we don't really use the bar chart, so it can be a bit confusing. Okay, the open is 2030, so this is the open, 2030. This particular wick is the open, this one. Okay, this wick is the open, this is the close, and you need to always remember that left side is always the open. So in the red also, this is the open, so left side is always the open. Now go back to the chart and tell me what you understood. Is this a red candle or a green candle? This is a red candle. Okay, until now we've been saying wrong. Why? Because we assume this to be green, but yeah, that's because this book does not have any color in it, but this is a red candle. So this is my opening price, this is my closing price. Okay, opening price, closing price, red, opening price, closing price, green, opening price, closing price, green. So always remember, left is the open and right is the close. Okay. Okay. Following and prior to the 2 bar reversal, low bar prices should be vicinity of the top of the bars. Alright. So if you look at this pattern acts as a consolidation, and you can basically take a trade when there is a breakout from this particular pattern. Now failure rates are 5%, and usually it is said that you should use it on weekly charts because they work the best on weekly charts. So that is my 2 bar reversal. Now we come to the the horn pattern. What exactly is a horn pattern? So horn pattern is basically in the shape of a horns, in the shape of horns of an animal, which is why it's called as horn. Like look at this, you can clearly see a horn, right? So this is what is the horn pattern. There's a fall, then two horns of the same direction. In the middle there is a random bar, and then it goes up again. So this is what a horn looks like. The price first came down, again went in one direction, and if you look at this, it closed in the same place. And then, so how to read the price action when you're looking at a chart like this? It opened over here, closed over here, there was a red thing, and here finally a doji happened, and doji shows me that the trend is now weak. And then here there is a tiny consolidation candle, and then finally there's a green candle whose body, whose high and low range basically is matching with the doji candle over here, and then it goes up, and this is a horn pattern which is showing a reversal. So how am I going to remember a horn pattern? It's very simple. Just keep that in mind, that horn pattern is identical to the pipe, but the difference between the pipe and the horn pattern is that there is a small candle in the middle which is separating the two horns, and this is not there in the pipe formation. So there's one candle, this is red color, then there is a doji candle, there's a middle candle with whatever, there is another candle, now this one is green, and then there is another candle. So the length of this and this, they are known as horns. Okay. Moving on, we have what is known as the inside bar. An inside bar is basically nothing. Inside bar means a candle which is inside another candle, and usually what people do is they trade the breakout of the inside bar. That's what people usually do. So if you look at this particular bar is inside this particular bar, right? And you can see buy next bar at opening above the inside candle close, sell below the inside candle close. So now next day, wherever the candle opens, you will enter over there. If the candle goes above the close, you will buy upside. If the candle goes below the close, you will buy downside. That is how you are going to basically trade a inside candle. Now if you look at this again, you will buy above this. Why am I only buying over here, and why am I not selling over here? Right now we just saw that we'll sell over here because here there was no movement, so we are considering both the directions. But when you look at this particular thing, you can see that the current close is higher than my previous close, so which may showing me that there is some kind of a buying momentum, so I will only buy above it. Okay. Moving on to the next thing, we have the 4-bar sell pattern with an inside bar. 4-bar sell pattern. What does that mean? So you have a normal rally going on, and it created a higher high as well as a higher low. And then you have one inside candle which is in the territory of this candle but in the middle of this. So then what will you do? You will basically sell on open below mid range and close inside the bar. So if the price opens in the mid range and it closes also below, then in that cases you are going to sell. So that's known as a 4-bar sell pattern. Now we come to something which is known as a hook reversal day. What exactly is a hook reversal day? So if you can recall from the CMT level 1, we have discussed what a hook is. Hook is basically a common term for a quick loss when a profit was expected. It comes from the fish book that a fish bites thinking that the bait is a free meal. A hook reversal occurs after a series of upward thrust bars called run bars when they occur right after each other. Then suddenly a narrow range bar occurs, with specific characteristics, the narrow range bar must be open above the previous high and close below the previous low. So in that case, obviously your SL will be hit because it opens above the high and closes also below. So in that case, your SL will be hit. So hook formation is basically hooking the traders who think that the trend has now been reversed, and then they fall prey to this. Next we have what is the naked upward bar reversal. So a naked bar is the one which closes below a previous low. So that is basically closing below a previous low and is a down bar. It is this most bearish close possible. If an inside bar follows a naked bar with an open greater than the naked bar close, it is a sign that the downtrend is reversing. An upward break from the inside bar would suggest the bears are caught. Did you understand? If there is a big red candle showing a bearish thing, if there is a big red candle and if an inside bar comes there but it opens greater than the close of the naked bar, in that case it's a sign that the downtrend has come to an end, and you will buy when the break is there towards the upside. Now we come to Hikake. So what is Hikake? Hikake is basically failure. Hikake is a failure. Hikake is an inside bar failure. So if it's a Japanese word. So if you look at it, until now what we were discussing is there are two bars and there is an inside bar. So as soon as this breaks, you will basically enter, but then what happens? Your stop loss has been hit and your inside bar low has again been broken. So you will now take the downside trade. So that is known as a Hikake. Hikake is a failed bar. Other multiple bar chart patterns. 1 or 2 day patterns are common, easily defined, but they are not always reliable. Complex patterns are subject to interpretation by the analyst because their formation is not a perfect fit to the ideal. Between these pattern types are patterns with few bars that have simple rules but require more price action than short term. Okay. Now we talk about what is the correction within a trend. Now what exactly is an outside bar? It is just the opposite of an inside bar. So when this was an inside bar, so outside bar would obviously be the opposite, which is like this. So outside bar occurs when the high is higher than the high of the previous bar, which is obvious over here if you look at the diagram, and the low is lower than the previous bar. So it basically covers the entire price action of the previous bar. Alright, and outside bar is basically a thought of as a bar of increased volatility. So if you look at this over here, we can see that this is an inside bar. Since why am I saying that this is an inside bar? Because this is how an inside bar looks like, we know that, and here you would have bought. And what is an out, just a second, yeah, so this is the same diagram where we saw the Hikake. Anyway, it's okay, we'll just revise it again. So Hikake is basically a failed inside bar. So when the outside bar closes near an extreme, that is a high or a low, and above or below the previous close, it suggests further action in that particular direction wherever it's going to close. Okay. Alright, that's it. Next, let's go to other multiple bar patterns. So 1 day pattern or 2 day patterns are very common. They are easily defined, but you can't really be very reliable on just the 1 day pattern. You obviously need to have more of confirmation before you rely on something. Complex patterns are subject to interpretation by the analyst because their formation is not a perfect fit to the ideal. Between these pattern types are patterns with a few bars that have simple rules. Let's see them. Okay, so the first type of the other type of pattern we are going to see is correction with a trend. Now, whenever a trend is going on, usually there is always let's say an uptrend is going on like this. It will take a correction and then it will go up again. So this correction is inevitable, and this is something which will occur no matter what. And vice versa. If there is a downtrend, the correction will appear on the upside. So the reward of catching the trend at a cheaper price as well as having a closer stop level will outweigh the potential opportunity loss of missing out on the trend. Alright. So we all know what opportunity loss is. Okay. Alright. So next how do you basically identify the percentage of the pullback, or how do you know until when can the pullback retrace? So for that, what I personally do is I use the fib retracement tool, but what you can do is basically act on the percentage pullback. How much percentage do you expect for a usual pullback to be, and then from then on you can see. So when they tested, the Active Trader magazine basically tested in 2003 on 18 stocks, and the pullback 6% pullback system. So buy at 6% low below the previous bar and exit on the next open. So that was only 17%, because obviously you can't really test a system on just 18 stocks. Next we go to the knockout pattern, and knockout pattern also has a symbol where it is represented as the CKO pattern. So what exactly is a knockout pattern? Again, this is also a trend correction pattern like we've been discussing so far. And first is basically that there should be one pre-existing trend going on, a very strong trend going on in either of the direction, either an uptrend or a downtrend. So that is something which needs to happen first. Okay. And after that, let's say there's an uptrend going on. Strong uptrend is that the stock must have risen at least 10 points in the past 20 trading days, and a trend line draw through the price touch almost all bars. Okay, so you want the price to have risen in the risen in the last 20 days by at least 10 points. Now we also read what a linear regression line is. So they are basically saying that there more and more lines, they should have just a small deviation from the line. Okay, and they shouldn't be having very large swings and very that they want them to be together so that a trend line can be drawn. At some point the stock will develop a throwback of 2 to 5 days in which prior two lows will be exceeded. So only the prior two lows can be exceeded. Place a buy stop at the high of the bar with the second low. Okay. Now I'll explain that better if you look at the knockout pattern chart. So you can see that over a period of 20 days, this is the chart of Nikkei. You can see that this trend line has been respected, and over 20 days, a minimum of 10 points, or in fact more than 10 points have increased. So now where you will buy is, you will buy when the price basically pulls back for like 2 days. So here you can see that it pulled back 1 and 2. So you would enter above the high of this candle, stop loss would be below, and you would capture this entire trend. So that is known as a knockout pattern, and I hope you understood. Okay, oops. Now let's come to a very interesting thing which was again described by Larry Williams, and it is known as oops. So oops is basically to name an opening range pattern that profits from a sudden change in direction. So the opening range is something which has been very much debated upon in the entire history. Of course, ever since technical analysis came into existence, ORB has been something which is a very important discussion. So again, when the market opens, there is a sudden movement in another direction. So taking the advantage of that kind of volatility is what oops is basically saying. So the setup of this pattern occurs when the opening price on today's bar is outside the previous day's range. Okay, so that's the first and foremost thing, that the price of today, the opening price is outside of previous day's range at all. The stock opens today at a price below yesterday's range. A buy stop is then placed just inside yesterday's range in case the market closes the gap, indicating a reversal. This pattern depends on other traders acting in the direction of an opening gap and being caught when the prices reverse. Again, I hope you understood what they are trying to explain. Looking at this, so how much percentage of qualification does Larry Williams use? He uses 10% qualification. So that means that the pattern is for the first day to have a close within 10% of the low. The second day must open on a downward gap. If these conditions are met, place a buy stop at the first day's low with a sell stop near the second day's opening. So look at this chart over here. So this is how my first day, my market had opened. Alright. And you can see that the next day the market opened over here. This is where the market opened. So this is completely outside of this range, right? So what will I do? Since it opened over here, I will basically buy when it comes to yesterday's low, and I will buy when it reaches yesterday's low and take the advantage of it, and my stop loss would be my opening price. This is oops. I hope you understood. Okay. Now, we shark pattern is a very interesting pattern, and it is basically a 3 bar pattern. So in this particular pattern, you use at least 3 bars. The most recent previous bar must be okay. Look at the chart over here. So doesn't this look like a shark, right? This looks like a shark. So the first candle is wider. The second one is an inside bar inside the previous one. The third one is again an inside bar again, which is inside the second bar. So this looks like a shark trying to eat something, right? So where will you buy now? You will buy when this particular first bar has been breached, you will buy then. So this is a shark pattern with the break up. In case the shark pattern breaks towards the downside, you will short over there. So this is how a shark pattern looks like, and this place is known as an apex, which is the last inside bar. So I don't think there's anything to discuss over here. All right. Talking about volatility patterns. So, taking the advantage of volatility is one of the key things which every trader needs to keep in mind, because on certain days there is a very crazy volatility. On some days, the volatility is not that much. But volatility will usually give you a lot of points, especially if you are trading in options. You need the market to be volatile in nature. Otherwise, it is not easy for the premium price to move. So, if you think about the short term patterns, most of them do rely on expansion in the volatility. Like what we saw, the inside bar and the ADX and all of these. All of these are basically talking about the volatility of the instrument. Talking about a wide bar range. So, you know what a wide bar range is? It is a big body candle or a big candle. So, a big candle, a wide range candle, basically is covering a lot of range as compared to the previous candles. If you go on your chart, I've changed the color of my chart, by the way. The blue is the green candles and the white is the red candle. So if you look at the candles, can you see any wide range candle? I can see a couple of them. Looking at this particular candle, looking at this particular candle, you can see that as compared to these rest of the candles, these candles are extremely big in nature. So that's what they are known as the wide range candles. Okay, so how are you going to say whether a candle is a wide range candle or not? So it's more of a visual concept. Like I just looked at the chart and I just decided that this is going to be a particular wide range candle. So that's how it's going to be. All right. There are no definitive answers to the question. So range bar is usually with increased volatility. Okay, so increased volatility can also imply that there is a change in trend. Like if you look at this, until here the price has been rallying continuously towards the upside, and ever since it started making a big candle, the price started to come down, and it came considerably down. It came down. In fact, it took a pullback and it again started going down. So the wide range candles can be a beginning of a trend. So keep that in mind. That's it. Now we come to a narrow range bar, NR. You must have heard about terminologies like NR5, NR2, NR7 and stuff like that. So when we talk about the narrow range bars, we can see that these are also bars which involve high volatility. Narrow range bars indicates low volatility. Now, why am I saying that narrow range involves low volatility? Think about it for a second. When we were talking about range bars, which means a huge range bar. Now, why does a huge range occur? A price of a stock travels this huge distance because it is highly volatile. That is because the range is high. These are the range bars. If I'm talking about narrow range bars, which means the range is just very small. So in this situation, the price didn't travel much. So what does this show? This shows that there is no volatility or there is less volatility. Very simple, obvious thing. I don't think there's anything to explain in that. So yeah, wide range bars indicate high volatility. However, narrow range bars indicate low volatility. Okay, okay. So now when we talk about NR4, what is NR4? Let's see it through the picture itself. This is basically narrow range 4, right? So if you look at these particular bars, earlier there was high range bars. Suddenly the range became really small, right? And again the range became really small. However, you can see that this is the range of the last 4 days, right? And you can see that the last one became really small. So this is less than 1 to 3 days. So you'll buy above the high, you will sell below the low. This is what is known as a NR4 bar. Okay, now we come to VIX. VIX is the volatility index. Like for example, for India, you have the India VIX. You can look at the chart on TradingView if you're interested. Going on India VIX, so this is how the India VIX basically looks. Now, obviously, you can't buy or sell India VIX. This basically shows how volatile is the market today. And when the India VIX is high, which means that the volatility in the market is high, which means the anxiousness in the market is extremely high. If you look at this particular area over here, March 2020, the India VIX was this high. So that is basically showing you the volatility in the market. That is basically again showing you why was the volatility or anxiousness in the market this high during 2020. Obviously because of the lockdown and the COVID-19 pandemic, due to which the India VIX rose. So that is India VIX, and India VIX also basically shows you the volatility or the anxiousness which is present in the markets. And the principle behind these patterns, when these short-term patterns were developed, was also when they used to basically look at the VIX. However, you need to keep in mind that generally bottoms are more reliably signaled by the VIX than tops. Now we come to the intraday patterns. Until now we were just seeing a normal pattern which can obviously be applied on intraday patterns, but to discuss each, if we have to actually go in and discuss about the intraday patterns, let's discuss about the ORB, which is the opening range breakout. Look at this. So we can see that the 5-minute bars, first 5 minutes, second 5 minute and third 5 minute, mark the high and low of the both. Mark the high and the low of the first 15 minutes, which is the first 5 minutes. This is the low, this is the high, and trade in the direction wherever it breaks. So I will buy when this gets breached, and then you can see that my price went up further high. I would personally not I would not suggest you to trade this without actually backtesting it, because I do not like ORB, because I feel like ORB can lead to a lot of whipsaws. So that, okay. In the first article, he described how he calculates the specified amount called stretch above and below the opening that establishes the ORB 10-day average, and you can see what ORB worked well with NR4 and NR5 hook days, and ORB is basically giving you success if you combine it with the NR4 and NR5, so you can see that. Alright, now let's come to what is the ACD method. So by analyzing the action around the opening range levels, a good trader can find ways to take advantage of these tendencies and to act as a support or resistance. This is called as the ACD method. So what exactly is an ACD method? It basically uses the first few minutes of the trading or the first few minutes of the market opening, and it then tries to see, I'll tell you what it actually does. Let me just show you the picture, otherwise it's difficult to explain. Right, so you can see this. You can see the first few minutes, 1, 2, 3. This is the opening range, right? And this is the first 15-minute candle, okay? Here they're not using the 5-minute candle, they're using the 15-minute candle. Okay, look at this. This is not a 5-minute. So the opening range, the high of the first 15-minute, low of the first 15-minute. Now in the ORB, we saw that as soon as this gets broken up, we will enter. But then here they're saying that they have added an upper boundary, and when this gets breached, then you will enter. Now that is what is known as ACD method. There is a particular boundary which is broken, and only then you are going to basically use it. Alright, now this is the summary, that there are so many things, but we need to always backtest and we need to experiment before you actually use your real money. Now we come to candlestick patterns. We all know what candlesticks are. Very simple, very basic. Japanese candlesticks, and that is what we are going to read over here. Now this part of the day is going to, this part of the chapter is going to be done very quickly, because I am pretty sure each one of you know almost all of the patterns, also because we've done them in the CMT level 1. We know what a green candle is, we know what a red candle is, we know what is a high, what is a low, open, close, high, low, open, close. And yeah, now let's start. Now starting with something which is known as a doji candle. A doji candle is something like this, and it opens and closes at the same place, and the wicks are of the same side usually. So that means that wherever it opened, no matter where it went, it closed at the same place. So that is basically showing a system of equilibrium, and which is why it is known as a doji. Next we come to windows. Now what exactly are windows? Windows are simply the gaps which we have been discussing so far. So what does windows mean? Windows mean gap itself. Now we come to a harami pattern. Now what is a harami pattern? Harami pattern is basically a 2-day pattern. Okay, and a large body is basically a harami pattern is, see, wait, let me explain it again. Harami pattern has 2 body candles, alright, and in which there is a larger body of either color followed by a smaller body of either color. Okay, figure 11.20, look at this. Now there's another way where I like to remember this, and that is a pregnant woman. So harami is the same as pregnant woman. Why am I saying that? Because there's a big body with a little baby over here, big body with a little baby over here. So this is usually a reversal pattern, and this is known as a harami pattern. Harami pattern is, now let's say there's an uptrend going on, and there's a big green candle, and then there's a small baby of red color, then I can assume that a reversal might be in place. And if there's a downtrend going on and this occurs, I can see that a green has started occurring, a green baby has been occurred, so it can again go up. However, you can see that the spinning top can be the colors. That's what harami. Now we have hammer and hanging man. I think this is very obvious. This is what a hanging man is. This is what a hammer is. When there is an uptrend and a hammer occurs over here, then it is known as a hanging man. If there is a downtrend and this occurs over here, then it is known as a hammer. So keep that in mind. Alright, now whenever a hanging man and a hammer, whenever a hanging man basically occurs at the top, variation is known as a kasa or a paper umbrella when the body is shorter than the shadow. When the formation occurs at a trough, it is known as a hammer. So when the body is basically shorter than the shadow, it is also known as a kasa or a paper umbrella. This is how a paper umbrella looks, right? Okay. Now we know what a hanging man and a hammer is. Now what is a shooting star? A shooting star is just an inverted hammer. I don't think there's anything to discuss in this. It is an inverted hammer. Now engulfing. Engulfing is when one particular candle is engulfing the entire other candle, engulfing the previous candle. So if I have a candle over here, and if there's a red candle like this, it has completely engulfed this green candle. So those are engulfing candle. And okay, these are the engulfing patterns. This is what I discussed. Look at the color very carefully. White is always a green and black is always a red. I hope you are clear with that. Okay, now we have a dark cloud cover or piercing line. Now what exactly is a dark cloud cover or a piercing line? If you look at the chart, you can see that the next particular candle covered more than 50% of the range, and it's of the other color. Here again more than 50% of the range and other color. So this is a piercing line, and this is a dark cloud cover. And this is a dark cloud cover, and this is a piercing line. If you are not clear with the definition of a dark cloud cover and a piercing line, I can show this to you guys. A dark cloud cover is a 2-body pattern at the top. The first body is large and white. The second body is large and dark. The second open should be above the upper shadow of the first bar. An opening gap upward will close within the first bar 50%. So that is what is a dark cloud pattern. Now what is a doji star? if the doji body occurs outside the previous body. Okay, if my trend is going on like this and my doji occurs over here, it has no relation with the previous bars, so that would be known as a doji star. We know what a morning star is, we know what an evening star is, and so on. 3 black crows, 3 white soldiers, that is 3 green candles would be 3 white soldiers, 3 black candles, wide range would be 3 black crows. Morning star and evening star, usually what happens when there's an uptrend going on and evening is going to occur, so after a green candle, two red candles occur, after which a downtrend starts. Okay, and whereas morning star is when something good is going to happen, so after a significant downtrend, the downtrend basically comes to an end. This is an evening star, morning star, and the uptrend begins. Hopefully it's clear. 3 inside up and 3 inside down. Now what exactly is a 3 inside up and 3 inside down? Now at the top, if you have this, and in the middle there's an inside pattern and then there's a downward pattern. Basically an inside bar and a follow through bar. Okay, so whenever we are talking about 3 inside up, inside down, you are talking about the inside bar pattern with a follow through. 3 inside up, 3 inside down, that is clear. Now here they have given you the percentage of accuracy of the same. If you want to, you can use that. So that's it, we are done with this chapter. Concluding it, you know that we have basically looked at a number of them, and remember that short-term patterns are most often reversal patterns. Short-term patterns forming an opening high. Okay, just read this and always know that we need to ride a trend, and before you take any strategy which we learned in this chapter and put that up in your real trading, make sure to actually backtest it, because it is extremely essential for you to backtest before putting something down in practice. Thank you.